Hey guys, welcome back. And in this video, I'm making my first entry into what my portfolio looks like and what individual positions I'm holding going into 2024. And I plan on updating this somewhat periodically just to emphasize the fact that long-term investing should be just that, long-term. And I shouldn't need to update it every week, month, or even every quarter. Because honestly, positions should not be changing that frequently if you're investing for 5 to 10 years. Now that being said, I do actively do research on these companies to make sure that I'm investing in something that still makes sense and the thesis still remains. Now before I tell you what positions are in my portfolio and how much they're weighted, four of the things that I look for when making an investment is that they have a high return on capital employed, low cyclicality within their business, high network effects, and large potential growth in their industry moving forward. Now, these four things are not the only things that I'm looking for, as I don't think you can quantify what a good investment is just based off of one financial metric and three qualitative metrics. But I do think that this is a really good place to start, and it's where I start with most of the companies that I'm looking at. And again, I don't think you can just make a concrete list of the things that you're looking for, because I think if there was a stock screener type investment approach that always worked and outperformed the market, someone would have figured that out by now, and they probably would have been the richest person in the world. So I think it's important to just look at all of the different qualitative and quantitative things you can find on a company and just have a deep understanding of it before you make any investment. Now, with that being said, let's get into the first company that I own, my largest position, which is Amazon, at 17% of my portfolio. And Amazon is a company that I plan on holding for the very long term, as I believe that they've been able to foster a really strong culture that is just obsessed with the customer experience. And I think that that will drive long-term growth and profits within the next 5 and 10 years. Now, everyone knows about AWS and their retail business being dominant in their respective industries. And if these two businesses continue to grow and expand, I think that alone will offer market-beating returns. But the reason I am extremely overweight Amazon is not just because of that, it is also because they have a high-margin, fast-growing advertising business as well as their illustrious Prime membership. These four businesses offer great growth prospects going into the future as they expand into new markets and have secular tailwinds as more people come online and more people are spending their advertising dollars online. This combined with their culture and management make me believe that they will be long-term winners that will greatly outperform the market over the long term. And my next position is Tesla, and that sits at around 16% of my portfolio. And I'm heavily concentrated in Tesla because their business is becoming increasingly diversified as their company's culture is focused on manufacturing excellence while attacking massive total addressable markets. For example, the S-curves of electric vehicles, full self-driving, humanoid AI robots, sustainable energy, AI data center computation are all being aggressively pursued at this company. And usually I would be worried about a company who can't keep their eye on the ball in their core competency. But in this case, I think they're just making a really strong ecosystem of products that are capital intensive, rely on batteries, and use advanced software, whether that's AI or not. And I think over the coming years, people will come to realize that the value isn't just in the car market or just in any one segment of their business, but rather in the entire ecosystem that they're building. Although cars are far from a product like an iPhone, I believe they are following a similar path to success where they have their hit products like their cars, and they build on that with their charging networks, software, and more. The similarities don't stop there though, as one of Tesla's main advantages is their vertical integration that even Apple doesn't have. This allows them far more control over their supply chain and increased pricing power. With that being said though, Tesla's most attractive attribute in my opinion is how their teams continue to focus on efficiency in manufacturing while still aggressively growing and opening more factories. Most times companies go through stages of growth at all costs while either unprofitable or disregarding the efficiency of their techniques, while Tesla seems to be locked onto their mission of advancing the adoption of electric vehicles, which subsequently includes lowering the cost of electric vehicles so consumers can actually afford them by increasing the efficiency in their manufacturing techniques. And if they continue to approach their products with this type of attitude, whether it's megapacks or humanoid AI robots, I think there will be substantial growth for Tesla ahead. Now, my third largest position is ASML, and that's at around 15% of my portfolio. ASML is another company that I'm really excited about going into this next year and beyond because let's be honest, they're practically a monopoly within their industry. It is the only company capable of manufacturing the advanced photolithography machines necessary to make the advanced 3 and 5 nanometer processors suppliers need. And until TSMC, Intel, and Samsung are flocking to another company for their equipment necessary to make these chips, I will hold ASML, as they have proven that they will act responsibly in the use of their monopoly power, refusing to upset the regulators, and continuing to return value to the shareholders. Now, my fourth largest position is SoFi, and that's at around 15% as well. And SoFi is one of my largest positions currently because of the most recent run-up. Regardless, though, it sits at 15% of my portfolio for a reason. And that's because I believe all of their business segments within their banking and technology platforms will have strong growth ahead. And outside of their tech platform that could offer massive multiple expansion, their banking efforts have been more than impressive. For example, SoFi's net interest income has grown at an 82% CAGR over just the past 3 years, while their biggest segment, being their student loan refinancing, was shut down because of the pandemic and the student loan forgiveness that the government had in place. Now, that 82% over that time period is very impressive, but what makes me especially interested in this company is their management being exceptionally good at guiding and executing aggressive growth. Not to mention, they also have a great brand image by sponsoring one of the most premier sporting stadiums in the world that hosts international pop stars, NFL teams, and even worldwide athletic events. And this all brings wide awareness to affluent customers. Now, there's far more to understand about SoFi and their business, but if they continue to grow the top line at 25% while turning to profitability within the next quarter, this presents large growth ahead, not even including the technology businesses and platforms that they have created and are potentially selling to other financial institutions that could offer wide margin expansion. Now, my next largest holding is MicroStrategy at 13%. Now, I own MicroStrategy because I believe Bitcoin, being a scarce and hard asset, has a massive opportunity to consume a lot of the excess capital that our government and central bankers continue to create throughout our society. Now, I'm sure everyone's heard the elevator pitch on Bitcoin, so I'm not going to waste your time with that here. If you're curious about that, I have other content around proof of work and proof of stake and the differences between the two, as well as other things along those lines. But for now, let's move on to the next position, being Google, at around 9% of my portfolio. Now, Google's a company that's had a lot of speculation over the past year about whether or not ChatGPT will disrupt their business and make their business less efficient, as now they have to create these generative responses instead of just showing you the typical Google search. But in my opinion, I'm investing in Google because although they're reaching a maturation of their search business, they are huge players in cloud computing, AI, and YouTube. Not to mention that Google's share buyback program is very aggressive, and even if their business segments start to slow down in growth a little bit, they can financially engineer EPS growth with the share buyback program. So in my head, it gives me a level of safety investing in Google, knowing that they can financially engineer at least some level of growth while still having these huge tailwinds of AI, YouTube, and cloud computing. Now, my next position is MasterCard, and that sits at around 7% of my portfolio. Now, my investment in MasterCard is partly a defense against inflation, as well as just an investment in a really excellent business that has high returns on capital employed. And part of my thinking in this investment is that with central banks and governments hell-bent on devaluing currencies, MasterCard is in a really good spot to take advantage of that, as they just take a percentage fee of all the transactions, and they also provide services like fraud detection and many others to payment processors and the like. And I also see this as somewhat of a hedge against my Bitcoin position, as I think that the one certain variable here is that countries will continue to devalue their currencies, but we're not quite sure about how that will manifest into markets, whether that's into a store of value like Bitcoin, or payment processors continue to reap the rewards of this inflation, or real estate, or who knows where else. Now, the remainder of my portfolio, which is around 6%, is just in cash. And that's just for any good buying opportunity, but not for any certain reason in particular. I try not to let my cash position go above 10 to 15%, but sometimes the markets just seem more frothy and you don't feel like you can find a good deal at the moment. But every now and again, there's just a large pullback in a sector or a particular company in particular that you can take advantage of if you have some cash on the sidelines. Now, I want to make it clear about how this portfolio fits into my overall financial plan, because I think it's important for you as a viewer to know whether I'm putting all my eggs in this basket or it's just 10% of some fun money that I'm throwing together, because whether it's one of those or anywhere in the middle, that shows a lot of intention and how serious I am about this and how much skin in the game I have. So with that being said, I have around 10% of my investable assets in my Roth IRA, which has like index funds like the QQQ, VOO, and then I have approximately 40% in this main portfolio where I pick individual companies that I think will outperform over the long term. And then the remainder of all my investable assets is in Bitcoin. And I know that may sound crazy, but at the end of the day, hey, I'll either lose it all and you'll be right, or it'll be a really good trade that works out for me. But only time will tell. With that being said, that's all I have for you in this one. If you guys have any questions, comments about my portfolio and what you would change or what you have in your portfolio, leave them down below. And with that, I'll see you in the next one.